With the multitude and frequency of tax reform proposals, it can feel like Congress is crying wolf. Regardless, a number of clients often wish to use their gift tax exclusions in case they go away due to a future sunset or legislative change with respect to gift tax laws. So, if you have clients who wish to use their gift tax exclusions, it's vital to know how and to be explained to clients how they would go about doing so. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode, episode 242, we're going to look simply to how to use gift tax exclusions. As always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. A little bit about me. I do what I do because I enjoy speaking and teaching. So, if you enjoy this presentation or any of my other content, and you'd like to have me as an in-person or virtual speaker at an upcoming event, you can email me at griffin.bridgers@gmail.com. And if you'd like to subscribe to my newsletter to receive more exclusive content, please visit griffinbridgers.substack.com. Now on to the presentation. So, I've talked about the gift tax exclusions ad nauseum in a number of prior episodes, but as a quick overview, this isn't necessarily a complete list, but I want to hit the high points. There's 3 key gift tax exclusions to know about. One is an annual exclusion of $15,000 per donee for present interest gifts. Another is a lifetime exclusion, which is currently $11.7 million, which is applied as a credit against gift tax for any gifts for any given year which exceed the annual exclusion if it's available. And finally, before even applying these exclusions, it's important to note that there is an unlimited exclusion for direct payments of medical or tuition expenses on behalf of a donee. So, with those 3 key exclusions, it's also important to note that even though it's not an exclusion, there's in essence an exemption in the form of a deduction for direct or qualifying transfers to a spouse who is a U.S. citizen. So typically qualifying transfers to a spouse will not use any gift tax exclusions. So keeping that in mind, in order to use your gift tax exclusions, there's a standard you need to know, and that's making what's known as a completed gift. So without a completed gift, there is no use of gift tax exclusions, and if you take nothing else away from this presentation today, that's the key point you should know. From there, it's really semantics to dig into how do we define a completed gift. What's important to know on the surface that simply changing title to property is not enough. You have to look to essentially whether the transfer is permanent. So the standard to get there is to look at whether the donor of the gift gives up dominion and control over the property. Now that's a legal term, that's the standard under tax law, but a better way to state this is to say that you have to look to whether the donor has any power to take back the gift without the consent of the donee. If yes, the gift is not complete. If no, if the donor cannot take the property back without the donee saying yes or no, then you do have a completed gift. So, the question is what type of transfer is permanent or complete for gift tax purposes. To dig into this, it helps to look at some examples. Now, I bring this up because I've gotten a number of questions from clients recently, or even potential clients who want to explore quote-unquote revocable trusts for purposes of using gift tax exclusion. But a transfer to a revocable trust won't use a gift tax exclusion. It's an incomplete gift. Why? Because the donor has the right to revoke the transfers to the trust. So keep in mind that right to take back a gift keeps it from being complete and keeps the donor from using any gift tax exclusion. Similarly, if you put money into a joint bank account or add a joint account holder to that account, that's not a completed gift. Why? Because the donor can withdraw the balance of the account, including any prior contributions, at any time. There's no restrictions on that. Then finally, what we're going to look at in a few minutes is that transfers to an irrevocable trust are typically the standard for making a completed gift, but if the donor retains the power of appointment typically in a non-fiduciary capacity, that would keep the gift from being complete, even though the transfer is permanent to an irrevocable trust. Why? Because the donor hasn't given up dominion or control. They can use that power of appointment during life or at death to really change the donees of the gift. So the donees aren't settled unless and until that power of appointment is exercised, lapses, or is released by the donor. Now, it's important to note that these gifts can become complete if and when a distribution is made from either type of trust we've explained here to a beneficiary other than the donor, or in a situation where a joint account holder other than the donor withdraws funds from a joint account which were not actually contributed by that joint account holder. And one I didn't list here because it's more esoteric is on that irrevocable trust incomplete gift example. If the donor has a power of appointment and exercises it during life or allows it to lapse or releases it, then that will be treated as a completed gift at that time as well, based on the value of the trust assets at the time and the value of the exclusion available at the time. And that's the case for all these incomplete gifts. Even though they can be complete later, you don't want to rely on this because the intent is right now to use that gift tax exclusion. And it's still potential use with these, but it's unpredictable. It's not used until a later date. And you have no idea what the exclusion might be at that later date, nor do you know how much the trust assets might grow. There might be a larger gift in the future than there would be today. So with that being said, what are some examples of completed gifts? Now this list is a little bit bloated because I'm trying to be more complete than I need to, but generally it's really just going to be direct transfers to another individual or transfers to an irrevocable trust over which the donor hasn't retained any form of power of appointment other than maybe a fiduciary power, which is kind of a subject outside of the scope of today's discussion. Now, in terms of transfers directly to another individual, that's typically going to include full ownership or a life estate or a term of years or a remainder interest, with the caveat that the remainder interest wouldn't be eligible for the annual exclusion. That can also include transfers to a custodial account on behalf of a minor or to a 529 plan on behalf of a beneficiary of any age. Both of those transfers would qualify for the annual exclusion. Now, transfers to an irrevocable trust, which are completed gifts, are technically treated as indirect gifts by the donor to the trust beneficiaries. So, unlike direct transfers, these will not be eligible for the gift tax annual exclusion unless either the class of donees for whom annual exclusions are claimed have the collective right to receive all income of the trust proportionally on an annual basis, or each donee for whom an annual exclusion is claimed can withdraw, for a period of time, their share of the transfers to the trust up to whatever the annual exclusion amount is, which is $15,000 right now. You can also make transfers to custodial trusts that end at age 21 for one beneficiary and get the annual exclusion as well. Now, with that being said, the problem with completed gifts versus incomplete gifts is that the giving up of donors' control and dominion is that the donor has no ability to economically benefit from those assets in the future. Or do they? To get there, it may be a possibility that we can look at that, but we have to first look at that in the context of the estate tax, because typically, lifetime permanent gifts have two primary goals. One is removing the future appreciation and income of the gifted assets from the donor's estate. Now, the gifted value of the assets is going to be included in the estate tax calculation. I've talked about that on a prior episode. I won't dig into that today. But another secondary goal, which didn't used to be the case but is now more the case, is using lifetime gift tax exclusions in case they go away. Now, there's anti-clawback regulations under the estate tax regime which say that any use of the lifetime gift tax exclusion can't be clawed back if the exclusion amount goes away prior to the donor's death or is reduced prior to the donor's death. Now, it's unclear in terms of the operation of that and how the IRS might view that in terms of abusive transactions, which shoehorns into our discussion in a minute on whether the donor can retain economic benefit. But either way, really what that allows you to do is maybe accomplish the second goal here without accomplishing the first. But accomplishing the first really automatically means you're going to accomplish the second goal here. So, with that being said, those two goals tend to move in tandem with each other. Now, there could be some secondary goals of depleting the estate that might be subject to estate tax by really paying lower rate income taxes on behalf of a grantor trust, or maybe even gift taxes to the extent exclusions are used, but those things kind of run counter to the primary goals mentioned above and really rely on the facts, circumstances, and economics overall. So the big question is whether the donor can keep an interest and still have a completed gift. And the answer is generally yes, but there's a catch. And that's that there's no gift tax if a donor makes a gift to themselves. Now, when it comes to a trust, there might be. You have to have a qualifying gift in order to subtract the value of the donor's retained interest from the amount that's treated as a completed gift and subject to gift tax or subject to use of gift tax exclusion. So while this doesn't affect whether the gift is complete, as I just mentioned with those anti-clawback regulations, there's some uncertainty as to whether the IRS might even allow the use of gift tax exclusion if that's your sole goal, and if you intentionally create a trust that could be included in the gross estate and thus subject to estate tax from the outset. But there are some qualifying transfers that would be subject to estate tax potentially, but are treated as a completed gift and wouldn't run afoul of this anti-abuse type of uncertain rule. And those require that the donor make a qualifying transfer that's really a benefit guaranteed by frequency and amount. What that means is that the guarantee has to be in the form of an annuity or a unit trust interest. So you can have a grantor retained trust, which is typically a GRAT or a GRUT for an annuity or unit trust interest, respectively, or even a CRAT or a CRUT, a charitable remainder trust, where the donor retains an annuity or unit trust interest. Otherwise, the donor is going to pay the gift tax on the total value of what's put into the trust, including their own retained interest. And there's a cost here. Any beneficial interest retained by the donor, regardless of whether or not it's a qualifying transfer, will be subject to estate tax, which frustrates the goal of avoiding estate tax on the future income and appreciation attributable to the trust assets, which really comes back to the bifurcation of these two primary goals, that you can have two without one, and you're essentially going to be used or forced to just use two at the expense of one if you create a trust where the donor retains an economic interest. So the big key takeaway there is that the cost of using gift tax exclusion is that usually you have to give up the economic benefit of the gift. But there are some ways around this in the form of a completed gift, and there may also be a way around it in the form of a spousal lifetime access trust, which is a subject I've covered before and I'll link at the end of this video. But the key takeaway here, and the question that prompted this, is that clients are often confused on the difference between a revocable trust and an irrevocable trust. Just focusing on the use of gift tax exclusion, it's important to note that you can't use gift tax exclusion for transfers to a revocable trust. Only for distributions from such trust to individuals other than the donor. Now, we have no, and that's a typo, it should say donor on the second bullet point. There's no way to know the timing of those distributions, so it's important not to rely on that. And second, you can't use gift tax exclusion for transfers to an irrevocable trust, which are incomplete gifts. In other words, where the donor retains a power of appointment, which would be common for many domestic asset protection trusts or incomplete non-grantor trusts. It's also important to note that transfers to a U.S. citizen spouse, as I mentioned, may not use gift tax exclusion. That could include a direct transfer or a life estate equivalent where a spouse is given a general power of appointment. But if you transfer a life estate equivalent without that general power of appointment, you may be able to elect whether or not gift tax exclusion is applied to that transfer on the gift tax return. But that is also a subject for another time. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Please note that I cannot give tax or legal advice in response to your questions. But thank you for joining me for this episode of More Than 10 Minutes with Griffin, and I look forward to seeing you in the next one.